Hello, everybody. Welcome. I'm Coburn Shepik, your host today. This is our first partner fireside chat. We're super excited about it. We're going to be testing this a few times in, hopefully rolling it out on a monthly basis. Right now, we're set for the third Thursday of each month to pick a topic. Hopefully, we'll bring on some guests in the future. But for now, I will be your solo host. So for today, we're going to be discussing rising interest rates. Yesterday, we had another bump from the Fed at 75 basis points, which is the fastest rise or the largest jump in the funds rate in nearly 3 decades, 28 years. So we're going to start out with just some basics, understanding if there's any beginners on the call. We just want to cover, the few of the basics, and then kind of jump in later on the call on what, this actually means for the market and how people and investors can be prepared in very uncertain times. So topics of discussion today, recap on interest rates and what that means, an introduction on Dovetail and how rising interest rates affect commercial real estate. We'll just do a state of the market towards the end here, and then a forward outlook to wrap things up. So first of all, for the basic fundamentals here, interest rates represent the cost of borrowing money and are ultimately determined by 3 factors: the Federal Reserve, the U.S. Treasury, and the banking industry. So why do interest rates change? Decreasing interest rates or lowering interest rates encourage us consumers and businesses to spend and invest, buy buildings, which results in a boost of asset prices. And rising interest rates, on the other hand, makes credit less attractive and ultimately slows down the economy. So the Fed has these 2 levers, raising and lowering interest rates, and they have this set of resources, that being one of them, to control the economy. And so the Fed's ultimate goal is to keep rates at a healthy level of 2% that supports economic growth without letting the economy get too hot or too cold. I said 2% there. That's actually a factor in inflation. Sorry for my bit of a correction there, but the Fed is trying to keep rates as low as they can and have this lever to raise or lower to control the economy. So here we are, 2020, and interest rates are now rising. So what exactly had happened? So what had happened was during the COVID pandemic, the Fed reduced rates nearly to zero to help boost the economy and incentivize growth. So at the time, the economy stopped, GDP stopped or fell off a cliff as we all went into our houses and saved money, and there was a lot of fear in the market. So the Fed reduced rates down to about zero to help keep driving the economy forward and encourage spending. So at the same time, the supply chain ultimately stopped as well, which in turn created a massive amount of demand. So consumers still need certain things, and with manufacturing stopped and the supply chain halted, that create a massive amount of pressure on the supply side. So when supply can't keep up with demand, inflation increases. And so the Fed is rising interest rates now to help damper the inflation. So a little bit about us and Dovetail and what we're doing. And so I want to just take a few slides and express what we're doing at Dovetail, our mission. Dovetail is founded just as of last year, and I'm super excited for what we're working on and the mission that we're after. So we invest in exceptional real estate assets by combining our expertise with the track record of our best-in-class partners to insulate and grow the wealth of our investor consortium. So Dovetail is a private investment firm that makes principal investments using its own capital and capital raised from outside sophisticated investors, primarily into commercial real estate assets. We align with seasoned operating partners to strategically place capital and leverage our expertise to structure the risk away from ourselves and our investors. So a typical investment profile, what we're seeking right now, and this is just sort of a layer of it, but asset types such as multifamily, there's massive demand for housing. We've got a supply and demand issue still, regardless of what's happening in the economy. We're also looking at industrial. E-commerce is a huge factor coming into play now, and there's going to be a major demand for that asset class moving forward. We see some of the project types, acquisitions and development. We're looking at core plus, opportunistic, and there's going to be some distressed opportunities coming up. So this is just a layer. Obviously, we work all around the capital stack, and there's going to be some great opportunities coming up with the movement from the Fed, and alongside a lot of the other things that make up what is unfortunate, which is distress, but it's also going to create a ton of opportunities and open up different sectors or different investment profiles outside of the traditional common equity, which is where most capital is being allocated over the past 5 to 10 years or so. So we work with established and evolved investors who are attracted to investing alongside some of the world's best real estate operators and sponsors to insulate their wealth and reputation in an uncertain world. What our operating partners all have in common? So we partner with seasoned operators and follow 3 main rules for those we work with. Number 1 is an audited track record. So what have these operators done? What markets have they been in? Have they done a project like this, etc.? And it needs to be audited. We need proof. We need case studies. And number 2 is at least 2 economic cycles. So 2008 would be one of those cycles where we'd like to see an operator successfully navigated through. And a lot of them did. There's some that navigated through and lost everything, but there's a lot that actually did and not necessarily profited from it, but navigated their business successfully. And in that case, it was a win. And lastly, a strong co-investment. We like to see conviction with the people that the operators that we're working with. So 5-10% as a co-investment is what we're looking for. So our values, we are firm on the alignment of interest. It's one of the most important things for our business. This is a community of investors working on the types of investments that we're looking for come with, we believe, come with a privilege, somewhat of a privilege. And so we're very focused and serious about the alignment of interest between not only the investors, our investor group itself, so aligning investors with other investors that have similar risk profiles, etc., and as well as obviously along with our operators and the actual opportunities in the markets. And on top of that, we're very sensitive to risk as we're also a new company. And so the importance of the alignment of interest, even outside, beyond economics, is extremely important to us. And number 2 is communication. So as we all know, going into business, having partners, think about a spouse. If there's no communication, there's no great business relationship there or relationship in itself. And so for one, we have scheduled reporting that is, super important, quarterly reporting, monthly reporting. If there's active projects, we're actively, communicating the process and what's happening with those projects. And we're also firm on being proactive. So things happen in this business. Look at what's going on in the market right now and all the operators and sponsors that are going to have to be communicating to their LPs of what's going on in the market, what they see, and how they're, taking precautions. So being proactive in those moments, because they do happen, is super important to us. And next, transparency. Transparency goes right in line with an alignment of interests, being transparent in what we're doing and what's going on in the market, and which integrity lands right in line with that for us. So boldness is another value of ours, thinking big. And right now there is opportunities, but we're holding our dry powder for what we see an even greater opportunity over the next 6 to 12 months that will be coming to light, which we'll be diving into later. So also results. We are very results driven, and this is not your financial advisor giving you a call over the phone saying there's an opportunity and we've got to switch. This is transactional. We are a relational business. We are results driven, and if there's not something that we believe in and that we're opening our checkbook for, it will never come to your knowledge. And lastly, impact. We are very impact driven, environmentally, sustainability, and what we see over the long haul. We do not play any short-term games. So let's dive into it now. Thank you for taking the time of hearing me out and introducing Dovetail. So how do interest rates affect real estate? So there's several main points here, and there's a lot to this, and it depends on the market, depends on the timing, but there's three things that we're sure of that really are affected by interest rates. Number one is capital flows. Excuse me. So credit markets tighten when interest rates rise, making it super difficult for developers to build and operators to refinance. So what we're going to see is the operators and the developers who have gotten into projects for the last 12 to 24 months, and they're in a phase where there's events that need to occur called a development or a value add or a rehab project, where there might be bridge debt involved. And it is a risky time to be playing with bridge debt, because when it's time to refinance, there is so much movement in the market. Just yesterday, interest rates rose by 75 basis points. The Fed rose rates by 75 basis points. And so that hurts when that comes around. And it's likely that we're going to see another probably multiple of a base rise, such as the one we saw yesterday. So number two is the cost of development, which goes in line with the capital flows. Obviously, when interest rates rise, that ultimately affects the cost of development. And when the cost of development rises, less construction typically occurs. So developers, because of the scope of these projects, it doesn't hurt them to just wait, for a couple months to see what happens. And that's likely what we're going to see here. And so this, opens up an even bigger conversation, because we do have a housing supply issue. And yes, there is a lot of new units that are coming onto the market right now. So we'll see what happens over the next, the next 6 to 12 months. But either way, I would say it's a fact that less construction will occur, as of a month ago. And so lastly, cap rates. So do cap rates, are cap rates correlated with interest rates? No, but cap rates and interest rates, the difference is the risk premium, which does affect values. And so investors seek commercial real estate for yield. And so it's a race for yield. And so when the cost of yield rises, the demand for the yield rises as well. And so what I think that we'll see and what we're planning for is an expansion of cap rates. And will it boost the same as interest rates? No, probably not. But there is such a demand for yield because of inflation. I think this cap rates will tend to follow, and we'll see that over the next several months. Even today, and we'll get into it in a couple slides away, but already sales are starting to slow, and for sure on the residential front, but also on the commercial front. And so over the next few months, we'll really see if cap rates start to expand, which I think we're already starting to see it. So Moving on here, we spoke about what interest rates are and how they are affecting how they can affect commercial real estate, which is a huge deal. And we'll go into what we see moving forward here soon. But we want to talk about the market for a second and what we see. Obviously, we're experiencing very uncertain times, and we're already seeing negative leverage and issues with floating debt, and consumer credit is on the rise. And so that leads us into affordability and much greater conversation. So here's a slide after yesterday. This was just updated this morning before our call here. And so 75 basis points was increased yesterday, which is the fastest increase in 28 years, almost 3 decades. So for those on the call here, if you look at the slide, and we've got last 12 months and the increase of the graph for that, which is hockey sticking, straight up in the air. But keep in mind that interest rates were basically at 0 prior to this. So the graph below that, and you don't need to see this necessarily, you can look it up, but pull up the funds rate, the federal funds rate data, and the historical data. As we all know, we're at historically low interest rates still today. Now we're creeping up on the average, but we're still at historically low rates. And so what this does is, for one, it creates confusion, because half of us are saying, oh, well, interest rates are still low. So this does not mean much. If you look back at the 70s and the 80s, we're not even close to those times. And so, but the problem is the speed in which rates are climbing, alongside with all the other factors in the market: inflation, war, politics, all this stuff, and housing supply. So there's a greater conversation to this. And so, the fact is this: the fact is that we're coming into a time after a pandemic where there's major supply issues, lumber skyrocketed, inflation is at a serious point, and the Fed printed trillions of dollars, and this has all stirred up a bidding war for assets in seek of yield. And so for certain assets, investors have bid up these asset classes, such as multifamily in hot markets like Phoenix, where I'm at, where investors have bid up this asset class to a point where they're paying literally top dollar. And for those in more opportunistic projects where there is short-term debt involved, we're going to see, put it this way, over the next 6 to 12 months, we will see who has been doing math. And I think that we're going to see a lot of them who haven't. And it still is mind-boggling to me when we see some of these deals go off the market, and where a number that we would put on there, it doesn't even come close. And so I don't know how what kind of projections or what kind of math operators are doing right now, but we will see over the next 6 to 12 months what happened. But I am sure that some of the operators who have just began, who have not much experience navigating a credit cycle, those who have purchased assets for top dollar over the last 12 to 24 months, will be in a very challenging position over the next year. And we definitely will see some equity impairments. It's going to be a very challenging time. And so, yes, although we're at historically low rates, according to the basis and whatever else is in the market, this pressure of rising rates is going to squeeze operators. Moving on to our next slide here, inflation. Inflation just clocked in again. We updated this chart this morning. inflation just clocked in 8.6% as of May 2022 on the 12-month chart. So this is another eye opener because the Fed was actually hoping and was thinking that we were going to start to see a downturn. Now, if you're looking at the chart, if you're on this call, obviously that's not the case. It's spiraling up, and this now we're in a phase where, because of the time that and the increase, there's now worries about stagflation, and stagflation is basically when prices remain elevated, fuel, shelter, energy, all these prices remain elevated, and at the same time the economy is slowing down, which we are already seeing GDP slowing down. So when inflation remains, the economy is slowing down, that basically means stagflation, which is not a good thing because the economy is not growing, and it's actually it's biting a hole in all of our wallets over time. So what we've seen now, and I wish we had a chart here to show, but we don't for some reason. But what's happening now is consumer credit is going up. So if we look back over the past 12 months, and if you were to pull up a chart on savings rates, when the Fed printed trillions of dollars, the household savings rate became higher than it's ever been in history. Trillions and trillions and trillions of dollars that are pent up, which is why crypto blew up and why the stock market had such a good year, and why real estate like that. The printing of money had a lot of play in the investment world. And now, if we had a chart here to see the amount of savings is gone, and it's now just sort of hitting the public. I think I've seen recent chatter about the savings rate's going down. The amount of dollars in savings that the surge in savings is gone. It's not going down, it's gone. And at the same time, consumer credit is on the rise very quickly. And by consumer credit, we're talking about revolving credit. This is credit cards. And so when consumers start relying on consumer credit, when consumers start relying on credit to pay for everyday things like food and energy, then we're going to start to see a flip here, and it's going to get ugly. So the magical question is, how long can we last for on these elevated prices? How long can America pay $8 for a gallon of gas? Not very long. And and with rising rates and the influx in consumer credit, and that these rates are going to affect the charges on America's credit cards, it's going to get ugly. So commercial sales are down 16% in April. If you're looking at the chart here, if you're on this call, obviously we can see during 2020, commercial property sales stopped basically, as a lot of fear, and we were all locked up, and then they skyrocketed to historical levels in later in 2021, and now in April 2022 we're down 16%, negative 16% over the last from the past 12 months. So what does this tell us? It tells us a few things. Number one, it tells us that demand for the yield is decreasing. Demand for the low. This is putting pressure on cap rates, is what it's going to do, because there's the prices, the whisper prices from brokers are not getting met, and so these deals are sitting longer. And the ones that are trading, and we'll see over the next few months, are trading at greater periods of time on the market. as well as potentially expanded cap rates. And just on that note, expanded cap rates are still very extremely low, to the point where we look at some of these deals and it's like, these guys are crazy. So expanding cap rates in our market, this might be in the low fours for multifamily in particular. So times are crazy. Let's talk about a little forward outlook. So still at the top, here, still interest rates are historically low, and that is a fact. And we, just like the Fed mentioned yesterday, we're likely going to see several of the same hikes throughout the next few meetings. And I wouldn't be surprised if the next meeting, based on the trajectory that we're at as of today, if we see a full percentage increase, which in my opinion is needed. And it's going to stir up a lot of potential distress. Will cause a recession, maybe not, but it's going to cause distress for at least some of the operators that have acquired short-term projects in the last short period of time. It will cause some squeezing in those cases, but it's needed, and we're still historically low, and we could most likely in the macro level, I think that we can absorb that rate. Secondly, lumber prices are coming back down. This is great news. Obviously, interest rates have the cost of financing is going to double based on the last 12 months. Will double here soon, and so that alongside lumber prices going down doesn't do much, but it does, because lumber prices skyrocketed during and after the pandemic. They're like through the roof, and so they are coming back down. The way that it's looking, they should be back down to pre-COVID levels, by the end of the year, if we keep moving at the pace that we're moving now. So opportunities are still on the horizon, and a few of those cases. First of all, based on what we're talking about, and based on what we see moving forward, we're going to see some distress, and it's going to sort of unspiral slowly. It's going to take time. In our experience, it could take years in order for assets to cleanse and for the biggest and real opportunities to come. But we're going to see opportunities in the short term as well. Call it the next 6 months. There's going to be opportunities potentially for assumable debt. We've had incredible mortgages over the past few years, very low interest rates. There's going to be an opportunity to assume some of that, and as well as some opportunities in other parts of the capital structure, like private credit, hard money lending, some of the more the debt side of the aspect. There's going to be some great opportunities, that will come from the changes in the market. So some of the opportunities that we're looking at, obviously, there's still a massive demand for housing in certain growth markets. Sunbelt region, we remain bullish on those markets, and so housing, industrial, in those markets are still a demand driver, but it's all about the basis, and so we're holding on to our dry powder there. Adaptive reuse is another opportunity that we feel strongly about. So adaptive reuse, just to speak on that for a second, is basically the process of repurposing an existing asset for something it was not originally designed for. So an example of that would be, a popular example right now would be malls. We're seeing a lot of these big old malls that have been vacant in some cases for years, now being converted into mixed use type of properties, as well as hotels. Some of these old hotels where demand has fallen off from the pandemic, and now these could be reused to residential or apartments, and office to residential as well as another popular So those are the few cases that we're looking at, and there's definitely going to be some opportunities that come about and arise over the next, short term, and bigger and greater opportunities over the next probably 2 to 3 years. We're going to see the greatest opportunity that we've seen in many decades, and so. That's it for today. My name is Coburn Shepik. I really appreciate you all being here and being on our first Fireside chat. We're going to send out a survey on this as we're seeing what works, what doesn't, timing, etc., and potentially going to be rolling this out on the third Thursday of each month about this time, and we'll kind of verify those details. But we would love your feedback on what you thought about this call, and if it brought some value to you. So we are focused on the upcoming opportunities, and we love for you to join our wait list, get updates on the market and what we're doing as a company. If you're on this call right now, you can see our contact details. Visit our website, www.dovetailig.com. That's dovetailig.com, dovetail.ig.com. Join our wait list and stay up to date on the opportunities that are coming. Thank you again for being here. I'm Coburn Shepik. See you next time.